Now coming to the next chapter, financial statement. Financial statement in the accounting cycle, accounting process, it's a summarizing. Now we have reached to the summarizing. We start with the identification of transactions, preparation of voucher, source document, recording the transactions through the journal and subsidiary books. Thereafter we prepare the ledger, means classification. After classification we prepare the trial balance, we close the ledger, we prepare the trial balance, and after the trial balance, now we have to know the profit or loss of the business, how much profit the business has earned or how much loss the business has suffered during the particular period. As well as we have to know the financial position of the business, we have to know the net worth of the business, financial position, how much assets business have and what are the liabilities business have to pay. So this process is called, the last one is called summarizing. Here we will find out the profit or loss of the business, and we will find out and we will know the financial position of the business in terms of assets and liabilities. So financial statement, in summarizing we prepare the financial statement. Financial statement, there are the two part of the financial statement. One part is called income statement, income statement, and second part is called positional statement, positional statement, second one. So first one is income statement. In income statement, through this statement we calculate or we find out the profit earned by the firm or profit earned by the business or company, or if the loss is suffered, then we find out the how much loss the business has suffered during this particular financial period. In the income statement, there are the three things we have to know. First one, we prepare the, if it is a manufacturing company, then we will prepare the manufacturing account first to know the cost of production, to know the cost of production if it is a manufacturing company. And if it is a trading company, they purchase the goods and sell it to the market. They won't involved in the processing of the goods or in the manufacturing of the goods. They are not in the part of this production process. They directly purchase the finished product from the market and sell it to the ultimate consumers or the middleman. Then we prepare the trading account. So in income statement, manufacturing account will be prepared if it is a manufacturing company, or if it is a trading company, then we will prepare the trading account to know the gross profit or gross loss of the business, how much gross profit the business has earned or how much gross loss the business has suffered by preparing the trading account. Thereafter, next account is the gross profit or loss is transferred to profit and loss account. So next account after trading account is profit and loss account. Here we calculate the net profit or net loss of the business, net profit or net loss of the business. Thereafter, third income statement is profit and loss appropriation account. After knowing the profit, we allocate the profit by creating various reserves to meet the future uncertainties, and rest of the profit will be finally divided among the or distributed among the owner. Means if it is a partnership form, to the partner, if it is sole proprietor, then the sole proprietor, and if it is a company form of organization, to the shareholders. So for that we prepare the profit and loss appropriation account. So income statement, in the income statement we may prepare the manufacturing account if it is a manufacturing concern, and if it is a trading concern, then we'll prepare the trading account to know the gross profit or gross loss. Okay. Thereafter we prepare profit and loss account to know the net profit or not net loss. Thereafter we prepare the profit and loss appropriation account to know the divisible profit. Okay. Now coming to the positional statement. In positional statement we prepare the balance sheet. If we prepare the balance sheet, in left side of the balance sheet we write the liabilities. Liabilities, it may be the owner's liability or it may be the borrowed. So it may be the long-term liability, it may be the current liability. So all liability we write in the balance sheet on the left hand side, and all assets, whether it's a fixed assets, tangible assets, intangible assets or current assets, all assets we write in the right hand side of the balance sheet. So in the left side of the balance sheet we write the liabilities, owner's liability, owner's fund or borrowed fund. It may be long term and it may be short term liability. All liabilities we write in the left hand side, and all assets we write in the right hand side of the balance sheet, and both sides of the balance sheet must matched, must be equal. So in financial statement we prepare the income statement and positional statement. So in financial statement, this is the financial statement. Under this statement you see over here, we prepare income statement number 1, and number 2 statement, second statement is positional statement. Okay, first one is income statement and second one is positional statement. Under the income statement we prepare trading account to know the gross profit or gross loss of the business, and if it is a manufacturing account we prepare another more account over here. That account is called manufacturing account to know the cost of production. Cost of production, for that we prepare the, before trading account we prepare the manufacturing account if it is a manufacturing company. Thereafter we prepare the trading account, and if the business is a trading business, then directly we start with the trading account to calculate the gross profit or gross loss of the business. Second, after that the gross profit will be transferred to this account, and here we will calculate net profit and net loss. Net profit and net loss, either with the net profit or maybe the net loss. After that, after knowing this net profit and net loss, we prepare the profit and loss appropriation account. Here we allocate the profit by transferring the amount to the various type of reserves. It may be a general reserve, it may be any other sort of reserve to meet the future uncertainty, for the expansion of the business, for the diversification of the business. Here we are managing our finance. Our profit will be managed by us to see the future as well, taking into account the future policy. What will be the policy of the business, strategy of the business in years to come. Accordingly, the profit will be allocated under the various head to meet the uncertainty, for the expansion of the business, for the modernization of the business, and so on. And rest profit will be divided between the owners. If it is sole proprietor, then the sole proprietor. If it is a partnership firm, then to the partners, and if it is a company form of organizations, then to the shareholders. Okay, so in PL appropriation account we allocate the profit. This is also called allocation of profit. Allocation of profit. And objective of this statement is what? If you want to know the objective of income statement, to present a true and fair view of financial performance. Objective of income statement is very clear. True and fair view of financial position, that is our profit or loss. We want to know the true and fair view of the financial position, financial performance. Performance in terms of profit and loss. If you have performed well, then definitely the profit will be there. If you have not performed well, we will not get the profit, there will be a loss. So profit or loss, that is profit or loss. So financial performance, we observe over here true and fair view of financial performance. Coming to the positional statement. In positional statement, we see the health of the company, we see the health of the business, financial health of the business in terms of assets and liabilities. How much assets the business have, what are those assets, and what are the liability of the business, and what are those liabilities. For that we prepare balance sheet. Balance sheet is prepared. So one side of the balance sheet, the left side of the balance sheet we write all liabilities, and right side of the balance sheet we write all assets. So objective of balance sheet is what? Objective is to present a true and fair view of financial position. True and fair view of financial position, that is assets and liability, or net worth of the business, or the net worth of the business. Net worth of the business. We also want to know the net worth of the business. Net worth. Up to what extent the business is rich. External liability will be deducted from all external liability will be deducted from all assets. Total of assets minus external liability will indicate the net worth of the business, that up to what extent the business is rich. Okay. So to present a true and fair view of financial position, this is very important. Financial position, that is assets and liability, and here the true and fair view of financial performance. Here we want to know the performance, and here we want to know the position. So there are the two different words: financial performance in terms of profit and loss, and position in terms of assets and liability in terms of net worth of the business. So coming one by one, first we will start with the trading account. In trading account, what we compare? We compare the net sales minus cost of goods sold. In trading account, we calculate what? Gross profit. Gross profit will be calculated by us. Gross profit is equal to what? Gross profit means net sales minus cost of goods sold. Cost of goods sold. In short, it is also called COGS. Cost of goods sold. In short, we also write COGS. So net sales minus cost of goods sold is called gross profit. If net sales exceed the cost of goods sold, then it is a net profit, and vice versa. If the cost of goods sold exceed the net sales, then it's a gross loss. If this is higher, cost of goods sold is more than the net sales, then it's a gross loss. And if net sales exceed the cost of goods sold, then it is called, the difference will indicate gross profit. So what is net sales? If I am talking about net sales, what is net sales? Net sales is equal to total sales minus sales return. Total sales minus sales return is our net sales. Goods which we have sold, and out of that some goods are returned by the customer, that is called net sales return. So from total sales, you deduct the sales return, you will get the net sales. Question is, what is total sales? Total sales means total sales is equal to cash sales plus credit sales plus credit sales. This is total sales. Cash sales plus credit sales is called total sales. So cash sales plus credit sales is a total sales. From total sales you deduct the sales return, you will get the net sales. Net sales minus cost of goods sold is equal to gross profit. If net sales exceed the cost of goods sold, it's a gross profit. Now coming to the what is cost of goods sold? Cost of goods sold. Cost of goods sold. This is also known as COGS in short. We write the COGS in short. Cost of goods sold is equal to opening stock plus net purchase plus direct expense plus all direct expenses. Expenses are classified into two, direct and indirect expenses. Direct expenses. So we'll add opening stock, net purchase, direct expense total, and we will deduct less closing stock. Closing stock from this amount. Closing stock. We'll deduct closing stock. This amount will indicate cost of goods sold. This is cost of goods sold. So cost of goods sold means opening stock at the first day of the accounting year. Last year closing stock become the opening stock for this financial year. So opening stock plus net purchase. Net purchase means total purchase minus purchase return. What is net purchase? Net purchase means net purchase means what? Net purchase is equal to total purchase minus purchase return. Total purchase minus purchase return. So what is total purchase? Total purchase means cash purchase plus credit purchase. Cash purchase plus credit purchase. That is total purchase, credit purchase. So cash plus credit purchase is equal to total purchase. Now coming to the what is direct expense? Direct expenses are classified into direct and indirect. So direct expenses included wages. It may be a productive wages or productive wages or wages and salary. Carriage inward. So net purchase is equal to total purchase minus purchase return, and total purchase means what is total purchase? Cash purchase plus credit purchase is called total purchase. What is direct expense? Coming to the direct expenses. Expenses are classified in accounting: direct expense and indirect expenses. Expenses which are directly related to the goods, related to the productions is called direct expenses. Example of direct expenses are wages and salary, carriage inward, freight, factory rent, royalty, if it is based on production, royalty, import duty, dock charges if it is related to the clearance of imported goods. imported goods. Dock charges. Okay, factory lighting, heating. Okay, factory lighting, heating, gas, fuel and power, gas, fuel and power. These all comes under the direct expense. These all comes under the direct expense. Is it clear? These all comes under the direct expense. So the direct expense, what are direct expenses? Wages and salary, carriage inward, freight, factory rent, royalty, import duty, dock charges, stores consumed, factory lighting, gas, fuel and power, manufacturing expenses, production, expense on production means productive expense on production. These all comes under the direct expenses. So in trading account, I am talking about a trading account, we calculate the gross profit or gross loss. So gross profit is equal to net sales minus cost of goods sold. What is net sales? Net sales means total sales minus sales return. What is total sales? Cash sales plus credit sales is called total sales. So what is cost of goods sold? I am talking about this. What is cost of goods sold? Cost of goods sold is equal to opening stock at the first day of the financial year. The last year closing stock become the opening stock for this financial year, and this financial year closing stock will be the opening stock for the next financial year. So opening stock plus net purchase plus all direct expenses minus closing stock, you will get the cost of goods sold. So when I am talking about what is net purchase means total purchase minus purchase return is called net purchase. What is total purchase? Total purchase means cash purchase plus credit purchase is called total purchase. Coming to the direct expenses are directly involved in the production or it is directly related to production of goods or carrying the goods. Okay. So wages and salary, carriage inward, freight, factory rent, royalty, import duty, dock charges related to the clearance of goods which was imported by us, which is imported, factory lighting, factory heating, gas, fuel and power, stores consumed, manufacturing expenses and expense on production. This all comes under the direct expense. So here we will calculate the gross profit. In trading account we calculate the gross profit. Now coming to the journal entries which is passed by us related to trading account. First account what we prepare in the financial statement, trading account. So journal entry related to trading account. So if there is a purchase return, ledger of purchase return will be closed. Purchase return have a credit balance. So when we are going to close the ledger of purchase return, we will debit the purchase return and this amount will be transferred to purchase account. So purchase return ledger will be closed by transferring to the purchase account. So purchase return account debit to purchase account. Closing of the ledger of purchase. It's a closing entry for the purchase return. Similarly, closing entry for the sales return. Sales return have a debit balance. So when we are going to close the sales return, we have to credit the sales return and debit the sales account. It means sales return account is closed by transferring to the sales account. So the entry will be sales account debit to sales return. Sales account debit to sales return. Sales return have a debit balance. Okay, so when we close the sales return account, we will transfer that amount to sales account. So sales account debit to sales return. This is the closing entry for the purchase return, and this is the closing entry for the sales return. Now next is, in trading account we will transfer which account will be transferred to the trading account debit side. Trading account debit to opening stock, purchase, wages, all direct expenses. Opening stock is not the direct expense, it's an adjustment of the to find out the cost of goods sold. So opening stock we will write first. To purchase, wages, carriage inward or freight account, gas, fuel or power account, wages and salary account, productive wages, factory lighting and heating, factory rent, royalty and manufacturing expenses, if any. So that will be debited to trading account. Trading account debit. All these ledger balance will be closed by transferring to the trading account. It's a closing entry. Closing entry. This account is not going to forward next year. We will close it. How this ledger will be closed? These ledger will be closed by transferring the rest amount to the trading account. So trading account debit to these account will be credited. Similarly, fourth entry is sales. We'll close the sales account to transfer to trading account. Sales account debit to trading account. Transfer entry. Sales account is closed by transferring the amount to trading account. Now thereafter there may be we will compare the credit side and debit side of the trading account. If credit side of the total exceed the debit side, then it's a gross profit. Then on that case, in case of a gross profit, trading account debit to profit and loss account, the difference will transfer to profit and loss account, and vice versa. In case of loss, the profit and loss account debit to trading account in case of loss. So loss will be transferred to the profit and loss account. So PL account debit to trading account, and in case of gross profit, trading account debit to gross profit. Now coming to trading account. After knowing the closing entry which is passed in trading account, now you see the ledger of trading account. This is the format of a trading account where we will find out the gross profit and gross loss. So trading account, you give the heading trading account. Thereafter you write for the year ended 31st March, you write the date. It may be 2020 or 1999, whatever the year you write it. For the year ended 31st March, write the year. Your left hand side is your debit side, debit, and right hand side is your credit side. Left hand debit and right hand side credit. So format is trading account for the year ended 31st March 2020. Debit side particular amount in rupees, credit side the same thing, particular amount in rupees. Now come to the debit side. To opening stock, start with the opening stock. Previous year closing balance will be the opening balance for the current year. So opening stock purchase, you write the opening stock over here. Purchase, inner column, if there is a purchase return, you deduct the purchase return and write the net amount, means net purchase, in the outer column. Then wages or productive wages, whatever it may be, carriage inward or freight, gas, fuel and power, wages and salary, productive wages, factory lighting and heating, factory rent, royalty, which is based on production. Royalty must be based on production. Manufacturing expenses, this side you write the sales, means total sales, minus sales return. This figure will indicate net sales. Now credit side closing stock. If the closing stock is given outside the trial balance, then you write the closing stock over here. Means after the trial balance it is given, then you write over here by closing stock. Closing stock is valued at cost or market price, whichever is less. Cost or market price, whichever is less. Now you do the total. If the credit side total is more and debit side total is less, then difference amount indicate your gross profit. Gross profit, which is transferred to profit and loss account. Gross profit if credit exceed the debit. Suppose credit side total is 10,000 and debit side total is up to this. Debit side total is 9,000. So 1,000 difference indicate your gross profit. This difference indicate the gross profit. Or vice versa. Suppose vice versa, debit side total is more. Debit side total is, suppose debit side total is 11,000. Then what happened? Then instead of gross profit, there will be a gross loss because debit is more and credit total is less. Suppose credit side total is 10 and debit side total is 11. So then difference amount, gross loss, indicate what? Gross loss transfer to profit and loss account. Profit and loss account. 1,000 is the gross loss. In this case will be transferred to profit and loss. So depending upon which side total is more, if credit side total is more and debit side total is less, then there is a gross profit transferred to profit and loss. And if the debit side total is more and credit side total is less, then the gross loss transferred to profit and loss. So entry is what? Trading account debit to opening stock to purchase, to wages, to carriage inward, to gas and fuel, to wages, to productive wages, to factory rent, factory lighting, to royalty, to manufacturing expenses. Okay, purchase return will be transferred to purchase account. Purchase return will be transferred to purchase account. So purchase return account debit to purchase account. Purchase return account debit to purchase account. This is for sales account debit to trading account and sales return is transferred to sales account. So entry will be sales account debit to sales return, closing entry. This is for closing stock account debit to trading account, and if there is a gross loss, then profit and loss account debit to trading account, and if it is a gross profit, then trading account debit to profit and loss account. Either maybe the profit or maybe the loss. Okay, so is it clear how to prepare the trading account? Here in trading account we calculate the gross profit or gross loss that will be transferred to profit and loss account.